Imagine standing on the edge of two worlds, one grounded in unyielding stability, the other soaring with industrial dynamism. In a world built on uncertainty, where inflation, geopolitical tension, and shifting economic paradigms collide, Singapore investors face a choice: anchor with gold or ignite growth with silver. This is not about picking a hero, it's about designing a portfolio that thrives under all conditions. Throughout history, certain assets have consistently proven their resilience, not just because they generate high returns, but because they protect against what people often overlook: systemic risk, currency debasement, inflation cycles, and geopolitical shocks. Gold has been that asset for centuries. Its stability is not theoretical, it's empirical. It doesn't yield, it doesn't grow like a tech stock, but it does something very few assets can. It preserves value when everything else is repricing. And in 2025, with global debt levels at record highs, inflation expectations fluctuating, and real yields under pressure, the case for gold becomes less about speculation and more about insurance. The modern investor isn't just chasing returns anymore. They're increasingly seeking resilience, something that holds up when the rules change. That's where gold ETF enter the picture. In Singapore, gold ETF like GSD-C have become increasingly attractive to investors who want that core allocation in their portfolios without dealing with the complexities of physical storage. They provide liquidity, accessibility, and low cost, all while tracking the price of bullion. Their performance in the first half of 2025 has shown that, even amidst a relatively calm market, capital continues to flow into instruments that reflect long-term trust. This trust isn't just emotional. It's rooted in behavior observed during drawdowns, recessions, or unexpected policy shocks. When institutions reposition for uncertainty, they look for ballast, and gold continues to be the ballast of choice. But just as gold defends, silver advances. Silver has been performing in a markedly different way. It is both a precious and an industrial metal, and that duality makes it behave differently. It's not just a store of value, it's a proxy for economic activity. In 2025, we're witnessing a structural shift in the demand for silver. As the global push for clean energy, electric vehicles, and solar infrastructure accelerates, silver's utility in photovoltaic cells and electrical conductivity becomes increasingly critical. And with supply constraints already emerging from key producing countries, silver's price is responding accordingly. In fact, it's not uncommon to see periods where silver outpaces gold by multiples, precisely because of its volatility and leverage to global growth themes. Still, this momentum shouldn't be mistaken for randomness. There's a reason silver is rallying now, and it's not just because of industrial demand. Look at the gold-silver ratio. When that ratio reaches historically extreme levels, like we saw recently above 100, it tends to revert. That reversion isn't speculative gambling. It's based on the fundamental imbalance between the two metals' perceived value. Historically, when the ratio has exceeded those thresholds, silver has not just caught up, it has exploded upward. That's what we're starting to see in 2025. The asset is playing catch up, and those who recognize the pattern early are already positioned. But this isn't about picking sides. It's about understanding the roles. Gold is your stability. It's the anchor when the tide pulls away. Silver is your torque. It accelerates performance when economic narratives shift in your favor. They don't contradict each other. They complement each other. One protects, the other propels. A smart portfolio isn't built on the binary thinking of which one wins, but rather on how different components behave under different scenarios. So, in designing a portfolio, especially in a place like Singapore, where access to both gold ETF and physical silver is efficient and tax optimized, the question shouldn't be about choosing one metal over the other. It should be about weighting them appropriately according to your risk tolerance, your time horizon, and your broader exposure to inflation-sensitive assets. In 2025, with macro uncertainty still the dominant force, building that kind of complementary exposure isn't just prudent, it's essential. Every investor must navigate not only markets, but the environment in which those markets operate. Geography, regulation, policy stability, these aren't just background variables, they shape outcomes. And in the realm of precious metals, Singapore offers a structural advantage that most other jurisdictions simply cannot replicate. It's not just about where you invest, it's about the ecosystem that supports, protects, and optimizes that investment. In that regard, Singapore has positioned itself not by accident, but by design, to be one of the most strategic hubs for precious metals investors in the world. What sets Singapore apart is its unique intersection of trust, transparency, and tax neutrality. At the heart of that is its GST exemption for investment, grade gold and silver. While in many developed economies investors have to factor in consumption taxes or value-added tax on physical bullion, Singapore removes that friction entirely. That means when you purchase certified precious metals, bars and coins that meet the purity standards defined by the Inland Revenue Authority of Singapore, you're not penalized through taxation. This may seem like a small administrative detail, but over time, and especially at scale, it alters the cost structure of precious metals investing entirely. The ability to buy, hold, and exit without hidden tax leakage compounds over years and decades. This is how smart capital behaves. It looks not just at returns, but at what you get to keep after the system takes its share. The regulatory framework is also clear, consistent, and aligned with international standards. Investors don't have to worry about retroactive legislation, seizure risk, or arbitrary capital controls. These are not theoretical concerns. They are very real in many parts of the world where governments, under fiscal stress, begin to treat private assets as public solutions. Singapore's credibility in this space matters. Its monetary authority isn't just competent, it's disciplined. And that credibility translates into confidence for the investor who wants to hold real assets outside the traditional financial system, but still inside a jurisdiction that respects law, order, and property rights. And then there's infrastructure. Singapore doesn't just offer favorable tax treatment and regulation. It has built the physical and digital infrastructure that supports precious metals activity at scale. Vaulting facilities such as those offered by Silver Bullion or Bullion Star aren't just secure. They're independently audited, insured, and transparent. Investors can inspect holdings, track serial numbers, and in many cases, physically redeem. This is a level of integration between digital access and physical ownership that bridges the gap between theory and execution. It means you're not just holding a paper claim, you're holding metal with all the optionality that brings. In times of market stress, that distinction becomes critical. Singapore's role as a regional financial hub further amplifies these benefits. The ability to trade gold ETF directly on the SGX denominated in SGD allows local investors to build positions without foreign exchange friction. At the same time, international investors can route allocations into Singapore-based instruments, knowing they are plugging into one of the most well-capitalized, stable, and liquid markets in Asia. That combination of local access and global relevance creates a dual benefit: proximity and credibility. Very few markets offer both. There's a broader point here. Precious metals are often misunderstood. People think of them purely as static stores of value, but in the right jurisdiction, under the right framework, they can be dynamic components of a modern portfolio. They can be traded, collateralized, allocated, and even securitized, all while retaining their core identity as hard assets. Singapore makes that possible not through hope, but through policy, through intentional design. It understands that in an uncertain global economy, capital will seek not just returns, but refuge, and it has positioned itself as that refuge, not by declaring it, but by earning it. That's what makes the advantage real. One of the most overlooked signals in financial markets is not always the one screaming the loudest. Often, it's the quiet mispricing that persists for years until it snaps back. The gold-silver ratio is one of those indicators. It doesn't command headlines, but it has quietly forecasted some of the most powerful reversals in the precious metals market. When you understand what it means, what it reflects about market psychology, risk appetite, and real asset demand, you begin to see it not as a technical footnote, but as a window into deep structural imbalance. And right now, that window is wide open. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has floated between 50 and 70, but in extreme times, during crises, during massive dislocations, it breaks out. When it moves above 80, or in rare cases above 100, it's not just signaling that gold is expensive or silver is cheap. It's telling you that something fundamental is out of alignment. The market, in its risk aversion, has overcorrected. It has priced safety too highly and volatility too negatively. That's when the patient capital steps in. In 2025, we're in that moment again. The gold-silver ratio surged past 100 earlier this year, levels we've only seen during the COVID panic in 2020 and the global financial crisis in 2008. And in both those cases, what followed wasn't just a mild reversion. It was a powerful silver rally. In 2009, silver rose over 50% in the months following the peak in the ratio. In 2020, it outperformed gold by more than 2-1 during the rebound. This is the rhythm of the market. When risk perception peaks and begins to unwind, silver doesn't just catch up. It explodes forward. This is not speculative. It's grounded in supply and demand dynamics. Silver, unlike gold, has significant industrial usage in electronics, solar energy, electric vehicles, and high-tech manufacturing. As the global economy stabilizes or accelerates, silver benefits directly from real activity. And yet, when fear dominates, it gets punished alongside other industrial commodities. That mispricing creates the setup. As soon as risk perception normalizes, silver reprices aggressively to reflect not only its monetary value, but its utility. That's the opportunity. What makes this particularly compelling now is the structural context. Global inventories of silver are declining, new mine production is constrained, the energy transition is accelerating. These aren't cyclical trends, they're secular. The demand side of the equation is expanding faster than the supply side can respond. And with silver still trading at historically cheap levels relative to gold, the asymmetry becomes obvious. You're not buying at a peak, you're entering at one of the largest dislocations of the last 2 decades. There's also a behavioral element to this. When most market participants are anchoring to gold as the safer bet, which is rational given its history as a store of value. They overlook silver. That creates inefficiency. The narrative becomes overly concentrated on one metal, while the other quietly builds a base. Then, when the shift happens, whether it's driven by falling real yields, a pickup in industrial production, or just reallocation flows, the lagging asset doesn't just close the gap, it overshoots. This is where portfolio construction comes in. Most investors default to gold for hedging purposes, but they fail to recognize that silver, while more volatile, offers greater convexity in moments like this. The gold-silver ratio is not a perfect market timer, but it is a powerful signal when combined with real-world fundamentals. And right now, those fundamentals are pointing toward one of the most favorable silver setups we've seen in over a decade. You don't get many of these windows. When you do, it's not about chasing price, it's about recognizing imbalance and positioning before the market restores equilibrium. That's what this ratio is really telling you. One of the fundamental misunderstandings investors often fall into is thinking in binaries, either or, decisions that oversimplify complexity. In truth, financial markets are not made of singular truths, but of layered dynamics. In the case of precious metals, the choice is rarely between gold or silver. Instead, the most effective portfolios recognize the complementary nature of both, and they use that relationship to hedge, diversify, and optimize across varying economic scenarios. The question isn't which one is better, but how each performs under different stressors and opportunities, and how they interact within a broader, well-calibrated system. Gold serves a distinct role. It behaves like a defensive asset, a hedge against monetary disorder, currency debasement, and long-term inflation. It tends to outperform during periods of financial repression, when central banks suppress interest rates or debase currency through excessive liquidity. It's relatively stable, less volatile than silver, and more deeply integrated into central bank reserves and institutional strategies. Gold doesn't need momentum to justify its place. It sits quietly in the portfolio as the ballast, the thing you own when you're unsure about the rules of the game itself. When the risk is not cyclical but systemic, gold becomes the default. Silver, by contrast, plays offense. Its price is more elastic, more responsive to industrial demand, and more sensitive to cyclical shifts in economic activity. When global manufacturing picks up, when renewable energy investments surge, or when infrastructure cycles kick in, silver tends to outperform. It has a monetary legacy like gold, but its present value is increasingly tied to real-world utility in solar panels, electric vehicles, electronics. That's what gives it torque. It may underperform in periods of contraction or extreme risk aversion, but when momentum returns, silver doesn't just participate. It often leads. So when constructing a resilient portfolio, one must look beyond choosing a single metal. The power lies in how gold and silver offset and enhance each other. Gold protects during contractionary or disinflationary shocks. Silver thrives during expansionary, procyclical phases. When paired properly, they form a barbell. One side weighted for stability, the other for growth. The result is not just diversification for the sake of checking boxes. It's dynamic risk distribution. You're smoothing volatility while retaining exposure to asymmetric upside. This complementary behavior becomes especially important in environments where macroeconomic regimes are unstable. In the post-2020 period, and even more sharply into 2025, the global economy has not settled into a predictable pattern. We're moving through overlapping cycles of inflation, rate adjustment, energy transition, and geopolitical realignment. Traditional asset classes, equities, bonds, even real estate, are increasingly interdependent on policy decisions. Precious metals, particularly gold and silver, provide insulation, but using only one narrows your exposure to just one type of protection or opportunity. Using both gives you elasticity, protection from tail risk, but also participation in real-world rebounds. There's also the behavioral benefit. Investors anchored only to gold may become overly defensive, missing growth phases. Those solely exposed to silver may experience higher volatility and emotional reactivity during downturns. Blending both metals tempers that behavior. It creates psychological as well as financial balance, which is critical when navigating long cycles. This isn't about splitting the portfolio 50-50. The allocation should be proportional to your broader risk appetite, liquidity needs, and economic outlook. It could be 70% gold and 30% silver, or vice versa, depending on where you believe we are in the cycle. The point is to think in systems, not bets. Each metal plays a role, and when used in tandem, they create a self-reinforcing framework that adapts to different types of shocks and recoveries. In uncertain times, that's not just smart, it's necessary. Understanding the environment in which capital operates is essential. And when you look at Singapore in 2025, it becomes clear that the state hasn't merely adapted to global economic shifts. It has positioned itself to benefit from them. In a world where institutional trust is deteriorating in many regions, Singapore stands out as a place where transparency, rule of law, and infrastructure converge to attract long-term capital. This is especially visible in the behavior of investors who are allocating toward precious metals, not as fringe positions, but as core components of resilient portfolios. The surge in flows into gold ETF traded on the Singapore Exchange isn't a random spike, it's a reflection of deeper structural preferences. In an environment of global uncertainty, rising sovereign debt, and inflation that remains stubbornly above target in many economies, investors are not just searching for yield, they are searching for reliability, and they're doing it in a way that balances accessibility with security. Singapore offers both, with instruments like SPDR Gold shares listed locally in SGD. The barriers to entry have come down, liquidity has improved, costs have decreased, and confidence has risen. When capital can flow without friction, it moves more deliberately. That's what we're seeing now. There's another layer to this. As of mid-2025, Singapore's ETF market has reached record highs in assets under management. This isn't just about gold. It's a broader sign that investors are turning to more self-directed, transparent vehicles. But gold ETF are leading that momentum for a reason. They offer exposure to real assets without the logistical complexity of physical storage, and they perform in ways that complement a diversified equity and bond portfolio. They've quietly become a preferred tool for Singapore's increasingly sophisticated retail and institutional investors who recognize that hedging is no longer optional. It's foundational. That shift in investor psychology matters. For years, the focus was on growth at all costs. In a low-rate environment, the reward for taking risk was high, and the penalty for being conservative was opportunity cost. But now, with monetary policy becoming more constrained and inflation proving to be stickier than anticipated, the pendulum has swung back. Investors are more focused on durability than velocity. They want assets that will hold up, not just in bullish scenarios, But when volatility reasserts itself, gold, and to a growing extent silver, provides that layer of protection. Singapore's policy consistency has helped accelerate this trend. Unlike in jurisdictions where capital controls, surprise tax shifts, or regulatory instability cause hesitation, Singapore offers predictability. That predictability creates confidence, and confidence fuels long-term decision making. In an age of short-term headlines, Singapore's long-game posture is a rare advantage. It doesn't have to declare itself a safe haven. The capital flows speak for themselves. Investor behavior in 2025 also shows a rising interest in physical ownership alongside ETF. Vaulting services, especially those offering allocated storage with transparency and insurance, have seen a steady uptick. This dual-track approach, liquid exposure through ETF and physical security through vaulting, mirrors a broader behavioral adjustment. Investors aren't relying on one mode of protection, they're building layers, and Singapore's infrastructure supports that. From a legal, logistical, and financial perspective, the system is designed to give investors optionality and clarity. When investors respond to uncertainty by flocking to a specific market, it's worth asking why. In the case of Singapore, the answer lies in its strategic clarity. It doesn't offer the highest yield, the cheapest labor, or the largest population. What it offers is reliability, legal, fiscal, political, and operational. In an increasingly chaotic world, that reliability becomes a rare form of alpha, and those who understand that are not just preserving wealth, they're positioning for what comes next. So, what fits your Singapore portfolio in 2025? The answer lies not in an either or, but in a both, and let your portfolio be both fortress and accelerant, gold for enduring strength, silver for explosive opportunity. Craft that balance, and let the unpredictable future meet a portfolio designed to rise. Let this be your strategy, not speculative, but systematic, not institutional jargon, but purposeful design, not a fleeting trend, but built for what comes next.